dates are pushed off a bit, so you can kind of set your own pace. Does anybody remember what date? I've been doing so many of these, I can't remember.
Sunday.
This coming? Okay, so this coming Sunday, you got your first stuff due, so make sure you get in there and check it out. And let's see, what did I have due? 1 through 3 and the test too? I think so. Yeah, right? I have everything. I just put like all homework, tests, this Sunday, get on it. So, and it's not a good idea to leave that till, if it's due Sunday at 11 or something roughly, it's not a good idea to start at 10 o'clock. You will not do well. So start now is my point. Get on and get registered and start absorbing some of the material is my recommendation. But I'm kind of a free market guy, so I'm not going to force you to do anything. You can get an F if you want to. All right. Any other questions? So we basically wrapped up chapter 1. We're going to do one little last tidbits. I kind of wanted to come back to what we went through just to emphasize the fiscal and monetary policy, because most of the time we'll be looking at monetary policy here. And so interest rates and the supply of money turn out to be pretty intimately related to each other. The primary concern of the Federal Reserve over time has been inflation, keeping inflation low and stable. And so I like to kind of come back to what we hope are the 3 kind of primary goals of policymakers. 3 primary goals that we hope President Obama and Congress and Janet Yellen keep in mind as they're trying to guide macro policy. And one of those things I just mentioned is low, stable inflation. And what are some other things that they should have that we talked about in like Principles of Macro class? Oops, I don't think I silenced my gizmo. If you have not done so, feel free to take the time to do so at this time. What else? Low unemployment. You kind of went like this. I thought you were going to go with the other one. So low unemployment, good. And one other primary thing. And I would say, yeah, you're kind of right. Maybe it has an up arrow to it. Economic growth measured by GDP. What kind of GDP? Real GDP, the quantity of stuff. So we'd like to see economic growth or increasing real GDP, which is economic growth. More physical things. More physical things at low stable prices. So this is kind of like a sales pitch for companies, isn't it? We've got quality stuff, lots of stuff available at low stable prices, and we put lots of people to work. So that's kind of maybe a pitch at a micro level as well to some degree. Okay, so tying this back to the government. The government is in the business of collecting taxes and doing some spending. And that gives rise to government saving, or dissaving as the case may be. Government saving is equal to the amount of tax collections minus the amount of government spending. That spending comes in the form of Medicare, Medicaid, weapons of mass destruction, toilet paper for the White House, all kinds of stuff that the government spends money on. They collect those taxes. If T is less than G, saving is negative, and we call it a deficit. That's when we dip below, okay? And that's a flow variable to keep in mind, that this is going on over a period of time. It could be this quarter, this month, this year. It's a flow. It's like what it is, it is. What's the related stock variable to the deficit? It's kind of a cousin, the debt, right? So if we run a deficit this year of $1 trillion, it adds $1 trillion to the national debt. So debt and deficit are linked that way. Deficit's a flow variable, and the national debt is a stock variable. And one feeds the other. Okay, questions or comments there? All right. So we won't spend a lot of time on this right now. We'll kind of come back to it towards the end of the course with fiscal policy. We'll spend a lot of time on monetary policy for starters. All right, there's our picture of the deficit that we saw last time. Another market to bring into play here in Chapter 1, just to kind of give you this round approach, is the foreign exchange market. So in the foreign exchange market, we are really, what's it there to facilitate? I mean, why do we have a foreign exchange market? Is it just that we have currency speculators and, oh, there's those guys over there and maybe I can buy low and sell high and make a buck? Is that the primary function of having a foreign exchange market, is for speculators to turn a buck on currency? What's the primary function? For trade of goods and services, right? To facilitate international trade, because we want to buy some Chinese goods and they don't want our dollars because US dollars are not money in China, the yuan is. And so we have to facilitate that trade through the foreign exchange market. That helps facilitate international trade. Now that leaves room for speculators and money changers. What do those people end up doing? How do they help things out? This is a little bit deeper question. What do these guys do?
About people that are investing against other currencies.
Yeah, like pure currency speculators. It's like some people might look at that and say, you know, what is your value in life? You buy a yuan and you sell a yuan and you think you're doing something good for society? Right? That would be kind of their attitude. Like, you're just turning a buck. You're just a greedy, profit-seeking, do nothing for society. There's no wealth creation, none of the good stuff that some of our corporations do that engage in international trade and trade globally. What do you got to bring to the table?
The fact that there can be international trade because of them.
Okay, good.
I mean,
what else do they do?
It's technically a form of international trade anyway.
It is, but I'm kind of getting back to maybe if there'd be a criticism on, you're not really adding anything to value if we don't really have, if there's no intrinsic value in currency, we only have intrinsic value in the goods and services that it facilitates, then what good are you? Why do we have people that are speculators in the market turning a buck on?
This is just a guess, but I'm thinking that if they're buying a dollar when the dollar value is low, then they're kind of stabling out the lows and highs.
Okay, good. That's exactly what they're doing. Is they're kind of turning out every nook and cranny. And by the way, those currency speculators are also listening to the real trades that are going on, right? Maybe what's going on with the government in China and what's going on with how much is being shipped by slow barge from Thailand. And so they're keeping tabs on that. Their intent is to just make a buck on the currency. But their actions make the prices of the currencies more efficient. And they're reflecting actual market values of what's going on in Hong Kong versus what's going on in Germany. So their actions drive the price to its efficient level, where we'd like it to be, so that when we go to make a global decision and we look at the price of a yuan versus the price of the euro, we know that that price reflects economic reality of the underlying environment that's there. And those speculators provide that for us by turning over every nook and cranny and learning, kind of like a Las Vegas bookie does in a sense when they set odds on college football games this Saturday. Right? They really get in there and they learn about each team and they say, okay, I'm going to give 40 to 1. Well, they're putting their money on the line on what it is, and then of course people who take them up on those odds then makes the market fluctuate. But they're the ones that are setting that, listening to the market. And so one way to play, here's a little tip for you. I didn't think I was going to go this direction, but I got to tip my hand to my quantitative buddy that I went to graduate school with. When he would play those college pick-em games, you know, where you pick the teams and there might be a little thing and it's all just kind of fun. Maybe you just put in $5 or whatever. He would just go, he would not sit there like most of us, including myself, and say, oh, I kind of like the Gators this year, I kind of like this, I kind of like this. He'd go straight to Vegas, whatever the odds were, because it's straight up, right? When you go to Vegas, you put down $1, you might win 40 on an underdog, right? But if on these pick'em games, it's usually you're just picking the winner and the loser. And so if you go straight to Vegas, Vegas conveys all that information. They've done all the research. They know all these teams. They know who's injured. They know who's not playing, right? And so you pick the one with the highest odds, and that's your pick'ems. Just do it that way. And you will do pretty well on your games, unless your other buddies are doing it too, because then you're going to submit basically the same entry. But most people don't do that. They don't think that way. Okay? All right, so that's what this currency market provides. And here is the value of the US dollar. And this is over time from 1970 all the way to 2010. You can see the value of the dollar kind of peaked. And then it's kind of stabilized right in here, kind of went through a surge through the 2000s. And now the dollar's been appreciating or depreciating? Depreciating. Okay, so this index number, those of you who had the international trade, we kind of figured, we calculated how these indexes work according to the level of trade that you do with somebody. So we create an index that includes the yen, it includes the yuan, it includes all kind of a basket of currencies weighted according to how much the US trades with them. And then we see on average what's happening. Now, on any given currency, the dollar might be getting stronger or might be getting weaker. So this is the average of that weighted basket. Okay. So this just kind of leads you into the types of things we'll look at that underpin the decision making that goes on with the Federal Reserve determining the supply of money, what happens if we just increase the supply of money, using economic models to make predictions about these variables that we think are important. Okay, got an assignment for you for Friday. This is separate from the MindCon Lab stuff. There are some Excel exercises, and one of my goals here at Ottawa University in general is to develop better Excel skills. I really don't think any business student should leave here. Unfortunately, they have in the past, but without being fairly proficient in Excel. I think you'll find when you hit the job market that a lot of employers just expect it, or it'll be the thing that gets you the job versus not getting the job. So we're going to do a few exercises. These really aren't very difficult. It also exposes you to the data that's at your fingertips as it relates to money and banking. So on page 15, if you want to take note of that, page 15 of your textbook, which your digital textbook, remember, is the exact same pages, there are these things called web exercises. And it's really, it just guides you kind of step by step. It's really pretty easy. But it's going to link you to the live data, the most recent data, and then have you capture that in an Excel spreadsheet. And it takes you step by step of what the site should look like when you get there, and then the type of data that you're going to collect on interest rates. So, questions there? I'm just going to let you kind of run with that and bring that. Let's have you bring a physical copy to class on Friday. Just a copy of the output.
Oh, just.
So it ends up having you graph some data once you pull up the recent figures. Okay, it'll should be just basically one sheet or two at most. All right.
And those are interest rates?
Yes. All right, so Chapter 2 tees up the market system and the players. And again, in this class, we're going to drill down into the details. already in macro class, we kind of just started jumping in. We might have mentioned a few things, but we started saying, okay, there's the interest rate, and here's the loanable funds, and there's the interest rate, 10%. Right? We didn't talk about we didn't drill down deeper exactly into who these players are and what their function is. And so that's one of the purposes of this course. All right. I'm going to, by the way, skip some of these. I'm going to make comments as we go, and you guys will have access to all of these PowerPoints. But some of the ones that are in writing, I didn't shred through. I just made some edits. I wanted mostly to have some of the figures to point to, especially when we get into actual data. All right. So here's our marketplace. One of them. Lenders and savers. Households, businesses, government, and foreigners. That's all the players. If we think about our cigarettes and our basic circular flow diagram that I kind of blew up on day one, looking at the big global economy that you guys can reference back to at any time. These are our agents in the economy. And notice who the borrowers are. What do you notice about these two lists? They're the same, yeah. So in some cases, the government is acting as the borrower. Sometimes they're acting as the lender, right? So all four agents are in both sides over here. And of course, we can think about it at the household level. We have some houses that are saving. Maybe it's wealthier households or not so wealthy households, but different middle-class people are saving. Maybe they're older, nearing retirement, and so they've saved up a nest egg. And then we've got 20-somethings out there that are borrowing. Okay, so we got a mix of both people. So my question to you is, what type of transactions go on here in financial markets? I just kind of want to describe them rather than leaving them dangling here in the abstract. I'd like you to kind of think about some of the actual transactions. So give me an example.
Example, say I've got $10,000 that I want to put long term investment for somebody. Say I want a bond.
Okay. So you're going to buy specifically a bond from, let's say, GM.
Yeah, sure.
Okay. So that's a direct finance. So I'm going to make a distinction here between direct finance, a financial market that handles things directly, versus indirect. It's kind of where I'm heading with this. So in the direct markets, we have a connection from the lender to the borrower, kind of firsthand. So if you go and buy the $10,000 share of Apple and some new initial offerings in what's called the primary market, and you buy one of those, you've participated directly in the financial market. Now, most of the time, we don't do it that way. What is the usual thing that we do with our $10,000? That's Michael, somebody other than Michael here. What's the thing that we usually do when we save our $10,000? Where does it go? Okay, the bank. Where else? Good. I mean, the bank is one place. A mutual fund, possibly a mattress. Not usually the best rate of return there.
Right.
Okay. So what does the bank provide us that the direct purchase from Apple does not? What does the bank give us that's different in terms of what we're buying as opposed to buying something directly from Apple Computers, putting our $10,000 there? Okay, what do you mean by insurance? Rachel? Okay, so yeah, if you're putting it directly into account, you get that insurance which guarantees the amount up to $250,000, I think the limit's at now. So you've got that going for yourself. All right, so let's say we get a little bit riskier. What else might you do with the money? Because the bank account that has the FDIC insurance is pretty weak in terms of its interest rate. Why?
No, it's not. Because it's safe.
Because it's safe. In fact, really perfectly safe, as perfect can get in this world, right? Your money is absolutely pretty much bomb-proof that you're going to get your $10,000 back, even if the bank fails. All right. So in return, you get 0.5% on your rate of return. Maybe if you tie it up for a longer period of time, you might get 2% in today's environment. So that's not going to get you very fast. If you start doing some investment calculators on you guys being age 20-something and needing to reach age 65, your investment's going to look like this if you continue to invest in 1 to 2% type stuff. That's what we learned in personal finance class. What we'd like to see is something that looks more like a hockey stick so that you get up to a nice big fat amount up here. So what do you need to do to get it looking more like a hockey stick if you're talking long-term retirement savings? Higher interest rate. Okay, where are we going to get that from? We could go to the Apple stock, but what are some other options that we can do? Okay, CDs, that gives us that, Dave Ramsey calls those certificates of depression, rather than certificates of deposit is what they really are. Certificates of depression because they're not much better interest rate. But you're right, if you tie up your money a little bit longer, you'll get that. That's not going to get you the hockey stick here if we're looking for something getting 8 to 12% or even higher. I mean, it's last year I did pretty well with my investments, and it's not because I did anything super brainiac, but I got like 27% on my investments. And most people did. Like I said, it's not because I'm some sort of financial guru other than knowing my own limits and not to act too stupid. So what type of stuff do you need to put it in to have kind of that upward potential? Okay, what type of stuff were we putting it into? What sort of financial investments? There's kind of one buzzword that I haven't heard you guys say yet. So we could do a single stock is what I was doing here with the Apple purchase.
Mutual already said.
You did? What'd you say? Mutual fund. Sorry, yeah, I did not hear you. Okay, so mutual fund, yes. So that's going to put us into a large number of investments, right? All at one spot. Okay, so there's the thing that these financial intermediaries bring to the table is the lowering of risk through diversification and being able to take advantage of economies of scale and transaction costs. So, in order to make wise investments in the mutual fund, what does the company need to do if they want to be a top performer of mutual funds in the United States? What do they need to do? Research. Is research cheap? No. Is it easy for an individual to do lots of research on hundreds of companies? No. So it would be very costly for you to do that, to keep up in the investment magazines, what's all going on, current trends, blah, 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 blah. And so from an economic standpoint, we have economies of scale in the financial intermediaries. So they're able to take your money, learn about that stuff, and invest it in other spots while they capture a margin on what they pay you. If we're back to the bank business, they can catch a spread on what they pay you, which is perfectly safe at 2%, and what they loan it out to in terms of the residential mortgages, for instance, or other investments that they do. All right, so financial intermediaries bring that to the table. All right, where's my eraser? There it is. Now, another type of intermediary that is in the market is an insurance company that does kind of a similar thing. So let's just put here key points of intermediation to be a little more general, because I think we tend to get kind of loose with that. We want to really tie down what that means. So the institution or organization, gathers deposits or premiums, if we're talking insurance, and reinvests the funds into riskier assets. They exploit scale with research activities. Who remembers economies of scale? I kind of implied you knew what it means, but I suspect there's at least half of you that one kind of just went. Economies of scale. If that helps you at all. So as we increase the scale of production, what falls? Not the price. The price can eventually come down, but the costs, average total costs, in fact, long run average costs, technically. So the idea is that if we think about the cost of gathering information, if I have 10 employees and computers and networks and research databases, and they're my researchers, right? What is the cost of gathering a little bit more information at the margin? In other words, if somebody has to put in an extra hour of time, is that real costly? No, because we already got the computers, right? So the cost of the computers, the networks, that was observed for the first unit of information that I got, or the first, if you will, early on in the information process. I needed the computer, I needed the networks, and now each additional unit of information I get is pretty cheap. And so the marginal cost of information is low, which drives down the average cost. And so as I gather more and more information, the average cost per unit of additional information is falling. That's economies of scale. So a decrease in long-run average costs as quantity increases. We see this in, this is a little more abstract thinking about it in terms of information, but that's what a lot of service providers do, is they're information providers, right? So we can kind of think about it the same way, that the average cost per unit of additional information is lower as we keep providing it. All right, so we got the economies of scale, and they're able to bring diversification. What's diversification? If somebody has a well-diversified portfolio, what do they have? A lot of different things. Good. So we're not putting our eggs all into one basket, right? And then if I put all my money into Apple, and Apple's owner dies or something unbelievable like that, then all of a sudden maybe it could go down, right? But if I'm in a whole bunch of tech companies, then I'm more diversified. If I'm in tech companies and real estate and foreign companies, I'm even more diversified. And if I spread things out, then I have a little more stable ride. So diversification is investing in a broad range of securities in order to lower risk. And if you want to put in parentheses, don't put all eggs in one basket. Then the Easter Bunny might flip himself upside down. You never know. Okay, so questions or comments there? All right, we mentioned this a little bit last time. Debt and equity markets. So, who's in equities? What types of securities are equities? Stocks. So this is the distinction back to stocks and bonds. So, debt instruments and equity instruments. Primary markets and secondary markets. What's the distinction there? I mentioned the primary market earlier, but what does most of the activity, if we're checking the New York Stock Exchange today and we're looking at the indexes of the top 500 stocks, what are we looking at if that's up or down as we flip on the radio? Is that the primary market or secondary? Secondary, that's right. So who's in the secondary market? What is it? What's the distinction between the secondary market and the primary market? Gene, you want to take a stab, or?
The primary market is like when stocks are first given out by the businesses.
Okay.
The secondary market is like where individuals are trading amongst.
Okay, so the secondary market is where there's two individuals and they're trading a used item, so to speak. So does the secondary market generate any new additional funds for Apple? If Apple stock is traded, do they get a small cut of that little piece of the pie? No, they don't. Nothing at all, right? So there's a broker that might be in the middle that gets kind of a commission, but no new money goes to Apple for that trade. And so that's an important distinction. It facilitates trade among individuals and can help them build wealth and be able to provide liquidity to individuals, right? So if you need some funds because something happened in your life, you could go sell your shares of Apple. Somebody out there is willing to buy those shares of Apple. Apple doesn't get any new money, but that person does, and you get cash. They get the shares of stock, and you get the cash. So it helps provide liquidity and helps keep money and assets moving around. All right. Investment banks. What have you heard about them? What do they do? So this movie's so old, I don't know if anybody's, how many people watched it, but Wall Street from 1989. See a few heads shaking. All right, so if you're dealing with investment bankers in that movie, who are you dealing with? Riley, do you remember who is your, who's going on with investment banks? Do you remember from the one with Charlie Sheen? Yep, Charlie Sheen. Michael Douglas is Gordon Gekko.
I don't remember the name of the company, but I remember Charlie Sheen. He went and talked to Gekko.
Okay.
Try to get him to sell some stocks.
Right. So when we think about the investment banker in the primary market, they are packaging up things for Apple. Okay, so imagine this. Apple's in the business of making iPods and computers and other technology, right? they're not in the business of selling their shares of their company. So they go to a specialist and they say, hey, I'd like to raise $10 million by selling some stocks or bonds, by the way, and how do I do it? And they're like, oh, don't worry about it. Let me see. We'll put this value. Here's what I propose. I will give you this amount of money for that amount of shares. And the investment banker actually provides the liquidity directly to Apple, so that Apple gets it right away. They sold it to Goldman Sachs or Merrill Lynch or one of these other big Wall Street firms. So Apple got their money, and now Goldman Sachs takes those shares and brings them to the market. Now, what happened to Facebook when they had their initial public offering? Anybody remember?
Their stock price was inflated.
Yeah, it went down, right? So they had the initial shares were at I don't know, 32 or something, and anyway, they actually plummeted after they were sold. So sometimes the plummeting there, I think, happened more in the secondary market. So what happened is Goldman Sachs came out, they sold all their shares at $32 or whatever and dumped them on the market. The price rose to 38, and then it's like, what do we own with Facebook? Oh crap, there's not really anything here, is there? What kind of marketing plan does this Zuckerberg guy have? Nothing. How's this place going to make money? I'm not sure. I'm out of here. Sell, sell, sell. Price falls, and it fell below that initial offering price. As long as the Goldman Sachs was able to dump all the shares initially, they made money on the initial public offering, the IPO, initial public offering. And Apple, likewise, or Facebook in this case, they got the money that they wanted too. But the owners, like Zuckerberg, also own shares of their own company, because they didn't sell the whole company, right? He maintained, I don't remember, probably at least 50% or more.
I thought he was only like.
Did he drop down to 20? So a significant share of his wealth, almost probably all of it, was in Facebook. And so when that stock price falls, what happens to his wealth? It goes down too, because now his money is tied up in it. So that's the idea of an initial public offering, and it is an important distinction to keep in mind, because in this book we're going to be tracking money that actually gets to companies and money that just stays with households. And so the secondary market really is just money floating around amongst households and banks and firms and businesses. And the primary market is what's funding new activity within the company. Okay. Questions or comments there?
So is the investment bank better facilitating the initial public offering?
Yes. Yep. Completely. And so the company, when they're looking to do this, they might shop around investment banks. There's lots of investment banks on Wall Street. They can say, hey, I'll give you 32. Well, Merrill Lynch said that they'd give us 33. You know, what are you going to do for me lately? And they can actually shop to see what investment bank's going to give them the best deal.
So, quick question: in the case of Burger King, if I'm not mistaken, Warren Buffett's pretty much kind of like personal financing a good portion of the buyout, or at least
I'm not sure on that
Berkshire
one.
Hathaway.
Are they?
I think so, but he's turning over like management of a portion of his company to.
That's his MO, yeah.
Yeah.
So Warren Buffett's style is to find existing good companies and then let those companies kind of run themselves. He is not a central planner guy. He is very much in decentralized ownership. So Berkshire Hathaway has a number of different companies. I don't know what the total's up to. Does anybody know? Do you know how many companies? I mean, I would guess at least 100 companies, but we're talking multi-million dollar companies. And then he lets those companies just kind of do their own thing, and they have to report back to him, but he does not get in and micromanage decisions or anything. He doesn't run the company, so to speak. He just runs his investment branch of it. And then you can buy shares of Berkshire Hathaway, which are secondary market shares. So then you own a share of Warren's company that owns all these other companies. So it's kind of like a mutual fund in that regard. Yeah.
But wouldn't, if the company sells too
It can, yeah.
There's so many
Yep.
out
It depends on how they price it, and that's why it's a pretty big negotiation between the investment bank and the primary owner, because again, most of the time the primary owner is retaining a large fraction of ownership, and so when they do a public offering, they're allowing. A lot of times it was a closed company, could have been a private mom and pop shop like Marguerite Gibson starting up a dog food company, and they built it themselves, and it got pretty big, and they're like, you know what, I kind of want to retire. Instead of just trying to sell it to another person or organization on a private exchange, which is another whole area that's grown a lot in the last 10 years, is on private companies doing that. They can do this public offering. And once you put it into the public realm, then you're under the scrutiny of a whole bunch of other rules and regulations on what you have to disclose to the public with your books and everything. If you're a private company, you can kind of keep your books to yourself, other than what you have to legally show the IRS. But the IRS, in theory, is not supposed to share that to any other people if it's a private company. So you open yourself up to a whole new thing, and that's part of what the investment bank specializes in. They know how to put together all the financials, all the paperwork, all that stuff. That's what they do. That's how they make their money. Okay, anything else? All right. So the over-the-counter market operates very similar to like what a true exchange is, but here you've got dealers, large companies on Wall Street that are kind of inventorying companies, and they're like, oh yeah, you want to buy some Apple? Here you go. I'll be the dealer for it. So it's almost like holding an inventory of companies within your company, and then you facilitate trades that way in what they call the over-the-counter market. Money and capital markets. So the main thing when we see the word capital, think about longer term, greater than a year. And you can kind of tie that back to the economic concept of capital being buildings and machines and tools, things that have a longer obligation to them. So that's the type of things we have in the capital market, whereas money references something much more liquid and shorter term in nature. All right, so here's money market instruments. So the money markets are these highly liquid, fairly safe investments. And so Obama signing his name to borrow some funds for weapons of mass destruction is at the top of the list. Here, this is time series data, 1980, 2000, 2010. So we got kind of a long stretch here to look at what's been going on. And of course now with the deficits and the things that have gone on with the financial crisis, we are well over double, almost triple what we were back in 2000. And then you can see it was kind of stable here, these time periods. Here we had a pretty good jump in the 80s with borrowing. So since the 1980s and even before, the government's been running persistent deficits. And so we're seeing that reflected in the amount of treasury bills that are being issued. So here's your certificates of depression. So this is a pretty big element of a lot of elderly people. You might have grandparents that have CDs on a regular basis. They just want stable income. They don't want to take any risk. So a large fraction of funds are in those certificates. Large denominations, these are in $100,000 increments, I believe is still the large denomination. So you've got 100 grand. You're buying one CD and it's 100 grand you're putting in for large denominations. All right, commercial paper. What's commercial paper? You heard that word before? You might not have. Yeah, it's an IOU within a company, right? So when we think of bonds, we're usually longer term obligations. Commercial paper is usually shorter term stuff. So it's kind of the terminology again of short term versus long term. And then federal funds and security repo agreements. So repurchase agreements are some very short-term things, like a week long of people agreeing to funds. I won't get into the details those since we're running a little low on time, but you have a short-term bond, and you basically trade it with another company to give you like a 1-week loan. So I'm agreeing to repurchase it at a stated rate in a week, and you're going to make a little money on it. The interest rate's very low because it's all very safe, but that's this repurchase agreement. Capital markets. So now we're in the longer term. Kind of eyeball this list right off the bat. Stocks, mortgages, corporate bonds, not paper, government securities, government agency securities, state and local government bonds for when they want to build a new school or something. The school might issue those IOUs. Bank commercial loans for businesses, consumer loans, maybe for some cars and that sort of thing, commercial and farm mortgages. So if we have some big equipment, if we have a combine or something, that might fall into this category. So all of those things are kind of these longer term obligations. And again, we've got the time series over 1980 to 2010. And who's the big player in the capital market? Corporate stocks. So 17,000. Residential mortgages, about half. So all of the mortgages, I mean, just think, there's a lot of houses that have loans against them, right? All the mortgages in Ottawa and Kansas and the United States are all right here. What is this? $9,436? That's not too bad. 9.4 trillion. So 9,000 billion is 9.4 trillion. What's the GDP for the United States, roughly? 14, 15. It's actually kind of approach, depending on if we're looking at real GDP or nominal GDP. So just in your head, be thinking around 14, 15 trillion dollars. It's just kind of helpful to keep these numbers off the top of your head. That represents the income for the United States, how much money we're making. Remember, GDP is income. They're kind of one and the same from the circular flow diagram. What we spend on final goods and services equals the income that we get. So we're making about 15 trillion. We've got 9.4 trillion in mortgage debt. 17 trillion is wrapped up in the market value of all the stocks that are out there, corporate stocks. So 17 trillion. So let's see here. We start adding all these up, and we got about $35 trillion, probably somewhere in that range. Okay, questions or comments there? I'm going to come back to that one next time. We are done. So remember your homework for Friday. Do that Excel spreadsheet exercise. I don't think it's going to take you real long.
The other stuff's due the 8th, right?
Yeah, the other stuff is Sunday.